Hello and welcome. You're watching Money, Money, Money. I'm Sumera Abdi. Before we begin, let me wish all our viewers a very happy and a very prosperous Diwali. Well, it's been a tumultuous year, even very difficult at times, but we've powered through it, and finally the Festival of Lights is here. But everything is not shining bright, or is it? What should investors be betting on in the coming year? That's the question I'll be asking my guests this week, Gaurav Mashruwala, who's a certified financial planner, and Shashikant, who's the chairperson of the Center for Investment Education and Learning. So thanks very much to both of you, and a very happy Diwali as well. But I'm going to get to you in just a bit. Before I get to my guest, let me actually hand it over to Nigel D'Souza, who's going to take us through the year that was. Hi Nigel, happy Diwali. How's the year been?
Well, a very happy Diwali to you as well, Sumera, but it hasn't been a great year. If you just take a look at it from last Diwali till this one, the Nifty is down more than 1%, the Sensex as well has lost close to around 2.5%, and in dollar terms, the Sensex in fact is down by close to around 10%. In dollar terms, gold as well has lost a good 11%, but if you take a look at it, the rupee has depreciated as well, close to 8%, telling you that in rupee terms, gold would be down by nearly around 4 to around 5%. From the broader markets though, we have quite a few winners. The mid-cap and small-cap space is high by around 7 to around 14%, but the winning sectors have been under pressure in the last couple of months, but in the last 1 year, they've done very well. IT stocks have done well, pharma stocks as well have done very well, but metal stocks, they have been under pressure. They've lost close to around 40%. I'll run you through a few stocks then. Commodities haven't had a great past year, and that's replicated in a few stocks. Vedanta has lost out. We have seen Tata Steel under pressure, as well as Hindalco, while oil and gas as well have been under pressure because crude prices have been declining in the last 1 year or so. So some stocks losing are the likes of K in India. We have ONGC as well that has lost close to around 38 to around 50% in the last 1 year. Some banking stocks, they've got a bit of a knock. So PNB is out in there. It's lost more than 25%. And ICICI Bank as well, the big heavyweight bank, has lost more than 15%. Telecom stocks, they haven't had it easy. And if you take a look at it, the final list of all the Nifty losers, we have something like a BHL. The big one there is L&T. When that heavyweight loses close to around 13%, it always puts some kind of pressure on the Nifty. The auto stocks as well, Hero MotoCorp as well as Tata Motors, both of them have lost close to around 15 to around 20% in the last 1 year. But just take a look at this. Maruti Suzuki has been the biggest gainer. That's gained close to around 45%. That's from the Nifty stocks, the big outperformer. Some PSU banks didn't do well, but private banks, a whole host of them up for you on the screen. IndusInd Bank, Yes Bank, all of them giving you big returns. A few defensives, they've seen profit booking the last 1 year, but Lupin and a couple of IT stocks, they have done very well if you take a look at it in the last 1 year. Infosys as well in there with big gains. A few more gainers. Now just take a look at this list. Every stock is from a separate sector. So we have BPCL in there, Bosch, we have Asian Paints, Z as well as Ultratech Cement, all of them different sectors, big returns. But the big action really has been in the broader markets. A few stocks that are up for you on the screen, they've gained between around 50 to around 120%. Britannia's in there. We have Vocart as well, that's given you big returns. BEL, NCC, Dish TV, a whole host of them, they've given you returns of more than 50%, but then when there are winners, there are always losers. A few of them up for you. Something like an Amtech or Auto has been a disaster in the last 1 year. We have JB Group stocks, JSPL as well. They haven't made you any money. But let's hope that till the time we meet at next Diwali, let's hope that the Nifty gets up and cracking.
Nigel, thanks very much for that. And now to our two experts. So thanks very much for joining us this week. My first question to you is actually around what Nigel spoke about, which is equity. So everyone's been recommending of late that you invest in 2015 with a minimum of a 2 or 3 year time horizon and actually reap the dividends of it later. So the shift that we saw towards equity for the retail investor last year, do you think that shift is now complete?
Well, as far as a financial planner is concerned, our advice to a client has been always look at 7 to 9 years for equity. Now, it could be direct equity or equity as a mutual fund, so vehicles could change, and that still remains. It cannot be linked to past performance, number one. Number two, it cannot be based on predictions. So I would still encourage viewers that focus onto your goals, and if it's required, then do it. Don't do it purely because you hear, say, or what you've seen performance in last 1 year.
Okay, Uma, you deal so much with investor education, so I want to ask you this. What's a good case actually to be made for retail investors to convince them that equity is not all evil?
See, the thing is that you need that orientation towards business, Most of us who are used to monthly incomes, routine salaries, we haven't really been an investing public that is exposed to cycles. We don't have such an experience of cycles of, losing jobs, for example. Equity calls for a business orientation. Equity calls for investing in an idea. So I believe that the whole startup cycle that we are seeing, the whole new businesses that we are seeing, which is involving a large number of people, and people are seeing wealth getting created, then the patience for equity might come in. I don't think the majority in India is still looking at equity as a way to participate in the wealth of businesses.
Okay, Gaurav, what is it that's keeping this attitude at bay? What is it that's not convincing enough people to actually invest even small amounts in equities?
They're not clearly defined their financial goals, and that's where it starts from. So think of a situation where somebody is saying that I'm doing this SIP for my daughter's education, which is going to happen after 10 years. Now, the moment you have decided that why you're doing that SIP in an equity fund or an index fund or whatever, if you have said 10 years, you have mentally put that time frame, then 10 bad weeks of equity market will not bother you. So unless you are not focused, you are bound to have this problem. A generation of wealth happens only if there is experience, but here experience does not, they don't capitalize on their experience, they move away. So that's where they get
stuck. I take your point entirely that with goals which are not properly defined, you'll either end up just catching the tailwind or the backlash, as it may be. But Uma, you spoke about the orientation of people missing for equity, right? Is it also a big divergence between people who are in urban areas and rural areas? I mean, the bulk of India stays in rural areas, right? What is it that can get those people to actually, if not join, at least begin looking at it and maybe sometime in the future get onto the bandwagon?
I wouldn't make a differentiation here in terms of business orientation. I would think that those who are in rural areas actually probably understand cycles better because they are more exposed to the vagaries of seasons, for example. I do believe the problem really is in terms of awareness of vehicles, the lack of awareness about mutual funds as a product that can enable you access equity at a low cost is very low in the country. And of course, distribution has been a big limitation. You need to have people who will take products to the masses. So I believe that the industry, because if you looked at equity industry, I would divide it into, let's say, traders, sellers of IPOs and sellers of mutual funds. The first one is only going when there is a product to sell. The second one is not present. So I would see it more as a distribution problem rather than anything else.
Alright, so clearly, but the advice is for people to actually start tiptoeing into equity for sure, if not taking a wholehearted plunge. Alright, so on that note, we'll take a very quick break, and when we return, we'll actually talk about the asset class that is associated with Diwali. We'll crystal ball gaze into how gold prices may be trending in the coming year. Stay tuned to Money, Money, Money.